One of the biggest mistakes that we see from investors is making the wrong move at the wrong time. And a lot of times this will happen when the market's down. Sometimes it's an emotional response. As an investor, you see your portfolio down because the market's down, but you think to yourself, what if it gets worse? So what you typically see there is you've got somebody where the portfolio's down and they get more conservative with their investments. They're locking in a lot of those losses. As an advisor, as a financial planner, those are the mistakes that I try and help people to avoid. Sometimes this is a mistake I actually see a lot of advisors make where the market's down and if their client needs cash for something, maybe it's their monthly distribution, maybe it's a one-off expense, they go and they rebalance the entire portfolio, meaning they're trying to get every position back to its ideal weighting, which means they're probably selling some of their equities that are down with the market. That's another one that I don't like to see being made when the market's down. So in order to avoid those big mistakes, what we need to do is understand how the market moves. And by doing that, we need to understand there are three types of market volatility. The first type of volatility we call normal volatility. Sometimes it's referred to as a market pullback. And this is when the market's down between 4 to 9% off of its previous high. Historically speaking, this happens between 3 to 4 times per year. This is why we call it normal volatility. I like to compare this a lot to breathing. We as humans need to breathe to survive. The market's the same way. It's not always just a line going up. You see some variation of that pattern. Yes, it's that upward trajectory, but the market still has to breathe in order to keep on going. The second type of volatility we call a correction, and this is when the market's down between 10 to 20% off of its previous high. If we're looking throughout history, it occurs on average about every 15 to 18 months, so a little less common than normal volatility. Think of this, if normal volatility is the market taking a breath, think of a correction as the market just taking a deep breath. Still a very healthy thing to do. Think about the last time you had some good physical activity. For me, I like to play pickleball once a week. Well, yeah, if you have a good aggressive pickleball match, then you're probably taking a good deep breath, maybe periodically throughout that. It's the same thing with the market. Every now and then, usually you have to take a good deep breath. Now, if you were to look at the preceding 12 months of most corrections, usually you see some really good market returns. Usually that's why a need for a good deep breath occurs. So one of the things within corrections that I want to pinpoint here is usually if you're paying attention to the news, you're starting to see some trigger words pop up. One of them is recession. Well, a recession is not a correction. A recession has very much its own definition, more so associated with the third type of volatility, which we'll get to in a minute. But the reason I say that is less than half of corrections end up turning into that third type of volatility, meaning most of the time corrections will happen and guess what? The market's already back into recovery mode. The third type of volatility is what we call a bear market. Think bears are scary, sharp claws. We don't like bears. And this is when the market's down 20% or more. This is usually those really bad years, the ones that get people a little extra nervous. Again, historically speaking, if we're paying attention to historical averages, they happen about every 5 to 7 years. So again, more uncommon than corrections, but still something that we should be planning for. If I've got somebody who's just recently retiring, guess what? I'm probably planning for 5 to 8 different bear markets throughout their entire retirement. It's not something that we should be afraid of as long as your planner is planning for those events to occur. The best way to get through market volatility is, guess what? Just ride it out. You never want to sell anything. Again, going back to that emotional response, those are the things that we want to avoid. We want to make sure that we're planning for what your needs are and having a well-diversified portfolio. So that way, when that volatility comes, guess what? It doesn't impact you. Does it impact your balance? Yes. But guess what? It's not going to impact the money that you need to spend every single month. At Landing Point, we build portfolios around what your need is. So when we're helping somebody retire and we're talking about what the purpose for their portfolio is, the first thing we identify is, hey, do we need these dollars to send to you, every month or periodically, or maybe there's a big project coming on down the pike. We want to know those things because that impacts how we go about investing your portfolio. So when you look at your portfolio and sometimes you see that balance down, don't get nervous. It's all a very much healthy part of what the market does. This is exactly what we do at Landing Point. We help build financial plans to make sure that every aspect of somebody's financial life is built for volatility. Sometimes that's market volatility. Sometimes that's life volatility and the different events that take place that can throw somebody off of their original plan. These are the things that we really want to help our clients with. So if you want to know opportunities to take advantage of when the market's down, go ahead and hit subscribe and pay attention to the next episode. We're going to be talking about a few different strategies that are a great way to take advantage of market being down. If you're one of my clients, you probably heard me talk about how, when the market's down, you'll never see me nervous because there are plenty of opportunities that you can take advantage of. So go ahead and hit subscribe, and I'll see you guys on the next one.